Until inflation comes down, value stocks aren't done. As long as inflation stays elevated, it's hard for value stocks' advantage over growth stocks to fade. The mainstream narrative goes like this. The economy is growing, traditional industries benefit, corporate profits improve, so value stocks are performing better. This explanation sounds reasonable, but in my view, it confuses two variables. Economic growth and inflation are not the same thing. What truly separates value stocks from growth stocks is inflation. If you misidentify the driver, you track the wrong indicators. The moment GDP or employment data weakens in a given month, you'll think the force behind value stocks has vanished and you'll exit too early. But inflation is still running high. Let me nail down the concept first. Value stocks and cheap stocks are two different things. A value stock must clear three quantitative thresholds simultaneously. A price-to-book ratio below that of the S&P 500, a forward price-to-earnings ratio below the S&P 500, and a dividend yield above the S&P 500. Combine all three and what emerges is a company with tangible assets, current earnings, and a track record of consistently returning cash to shareholders. A value stock is worth what it is today. A growth stock is the exact opposite. Its current earnings are tiny or even negative, but the market expects it to be worth a lot in the future, so it commands a high valuation. Almost its entire share price is built on expectations about tomorrow. Why do value stocks systematically outperform growth stocks when inflation runs hot? The answer is hidden inside valuation models. The bulk of a growth stock's valuation comes from earnings projected many years into the future. Think of it this way. You pay $100 for a growth stock today, and maybe $60 of that is buying the present value of earnings from years 5 through 10. When inflation picks up, future money loses value. Those distant earnings have to be wrung out hard to reflect what they're worth today. The higher inflation goes, the steeper the discount, and the lower the present value of those future earnings. It's the same logic as bonds. Long-duration bonds get hit the hardest when inflation rises because their cash flows sit far in the future. Growth stocks are the long-duration assets of the equity world. Value stocks are different. Their valuation is mainly supported by current assets and current earnings. The money is right here, right now. You don't have to discount it across multiple years. The impact of inflation on the discounting process is naturally much smaller for value stocks. When inflation arrives, it hurts both value and growth stocks, but the degree of damage is not the same. The damage to growth stocks is far greater. This is purely because inflation pushes up the discount rate applied to growth stocks. The argument that strong economic growth drives value stocks simply doesn't hold up. Under the assumption that inflation stays constant, a strong economy benefits growth stocks just as much. Earnings expectations get revised upward, and growth stocks rise too. What actually drives the wedge between the two is inflation itself. Now let's look at the recent data. CPI year over year has gone from 2.4% to 3.8% to 4.2%. Inflation is re-accelerating. Over the same period, value stocks delivered a monthly alpha of 4.4 percentage points relative to growth stocks, which annualizes to over 60%. The financial market is already sending a precise pricing signal. Historical data, grouping every month since 1947 by inflation level, yields a clear conclusion. The higher inflation is relative to a year ago, the larger the excess return of value stocks. The lower inflation is, the smaller the excess return, or it even turns negative. This pattern reaches the 95% confidence level, meaning it is statistically significant and can be ruled out as random coincidence. Tracking the best performing investment institutions across the US reveals that nearly all of them are betting on value stocks to continue outperforming the market. Currently, across at least 3 institutions' recommendations, there are a total of 15 stocks being recommended simultaneously, and 13 of them are value stocks. That's 87%. These institutions are expressing a single judgment with real money. Inflation isn't coming down anytime soon, and the value style still has room to run. If you are still holding high valuation growth stocks right now, you are effectively betting against the collective judgment of professional money. You can take that bet, but you must be clear about what you're betting on. You're betting that inflation will fall fast. If inflation does not fall fast, the other side wins. Inflation and economic growth are synchronized in many periods. When the economy runs hot, inflation runs high too. The two variables get tangled together, and it's hard to tell with the naked eye which one is playing the dominant role. People saw value stocks outperforming when the economy was strong, and they attributed it to the economy. But if you separate the two variables and assume inflation holds constant, strong economic growth helps growth stocks at least as much as value stocks, if not more. The key variable that distinguishes the performance of value and growth stocks is inflation. Back to investing itself. If you agree that inflation won't return to low levels anytime soon, the advantage of value stocks over growth stocks remains intact. This is a style shift driven by the inflation environment, not a short-term rotation. For ordinary investors, the operational logic right now is clear. First, check whether your portfolio is overloaded with high valuation growth stocks. In a phase where inflation stays elevated, these stocks will face persistent valuation pressure. Their ability to withstand the environment is weaker than that of value stocks. When, at some point in the future, the inflation trend shows a sustained and material decline, the logic will reverse. The discounting pressure on growth stocks will ease, and the style may switch again. At that point, reassess and consider rotating back into growth. The strategy is not to cling rigidly to value stocks, but to follow the direction of inflation. Inflation running high, value stocks have the edge. Inflation persistently declining, growth stocks get their opportunity again. The basis for flexible adjustment is inflation data, not a rigid stylistic preference. Given the current market environment, inflation is here to stay for a long time. We cannot control the market, but we need to understand where the roots of this style rotation lie and how to adjust our positions in line with inflation's direction to improve the odds of our decisions. That is what I set out to do in this episode. Feel free to share. Is your portfolio tilted toward value or growth right now? Last but not least, if you enjoyed this breakdown, do hit that like button and subscribe. Data reveals the truth and logic guides the way. I'll see you in the next one.